Good morning, ladies and gentlemen. I have the pleasure of welcoming you to our Q4 2024 earnings call. Today in a slightly new setup as David Forth, our Group CFO, with making the presentation, and myself are not sitting in the same room as usually. I'm today participating from literally the other end of the world. From New Zealand, where I have been visiting the construction site of what to date is our largest EPC project, where we're building a 20 megawatt power plant in Pukenui for an external investor. So this is why today we have a slightly new format. However, on the proceedings, this will not have an impact. So again, welcome to you, and we will today go through the business results, which I will be presenting. David will guide you through the financial results, and we will then also compare the actual reported results for the full year against the previously provided guidance. And as usual, at the end, we will have time for answering your questions, which please kindly which you can submit in writing, and please kindly do so. So going through the various segments, starting with electricity generation, which we also refer to as investments. Here we had in the fourth quarter two major events. One was the sale of our two operating power plants in Australia with a total installed capacity of 14.5 megawatt peak. And these were sold in a transaction together with a project that was still in development, but very close to ready to build, to an Australian investor, a company called Clean Peak. This transaction was completed at the end of October 2024, which means that until that date, the revenues, but also when we count our or add up our produced electricity, the numbers until the end of October are included for those two operating power plants. Also in the fourth quarter, we completed and commissioned our to date last power plant in Romania, which is a 3.2 megawatt peak power plant in Sarodești. And at this point in time, we are in the process of completing the construction, and very soon we'll start the commissioning of three new power plants with a total installed capacity of 5.1 megawatt peak in Hungary. And for the time being, it appears that these will be the last power plants from our development efforts in the Hungarian market, given that going forward it is relatively complicated to obtain grid connection capacity in this market. Looking at the energy generation, in the fourth quarter of 2024, we generated 23.4 gigawatt hours of electricity, which represented a decline of 6.6%. And that is mainly driven by the disposal of those two operating power plants in Australia, which, given that they were based in they still are based in the Southern Hemisphere, had the highest generation during the European winter and the Australian summer. So those 2 months of November and December of generation that we were not recording anymore outweighed the growth from the added capacity in Romania between the fourth quarter 23 and the fourth quarter 24. Looking at 2024 as a whole, we increased the generation by 18.4% to a total of 165.5% kilowatt hours, my apologies, against the nearly 140 gigawatt hours the year before. Looking at the specific yield, here we also had a decline from 200 kilowatt hours per kilowatt peak recorded in the fourth quarter of 2023 to 173 kilowatt hours per kilowatt peak in the fourth quarter of 2024. Again, mostly driven by the disposal of these Australian assets, because logically during summer, with their very high specific production, they were contributing to this number very significantly. Looking at the average realized electricity prices, here we have seen between the third quarter of 2024 and the last quarter a decline from 173 euros per megawatt hour to 136 euros. And the main driver of this decline were the regulatory changes in Romania, where the power plants that we are still operating under the offtake agreement with Transelectrica became subject to new regulations as of September 1st, and of course had the full impact during the fourth quarter, where we are compensated for every megawatt hour with a maximum of 80 euros per megawatt hour, even if the market price is above that level. If the market price is below 80 euros, we get that price per megawatt hour. That means we are capped at 80 euros. And unfortunately, in addition, we are also not compensated on weekends and public holidays in Romania. And last but not least, we also hit by negative prices if they occur. So this has had a significant drag on our revenue generation from our Romanian portfolio. Of course, with the exception of those power plants that have already exited this mechanism by obtaining a license and selling into the day-ahead market in Romania. And as mentioned previously, we are working very hard on moving our Romanian portfolio out of that Transelectrica arrangement, obtain the license, and start selling into the electricity market. And the good news there is that in the fourth quarter, but also in the first quarter 2025 to date, we are realizing significantly higher prices than 80 euros, as market prices have been consistently above 100 euros, and on some days we even generate around 150 euros per megawatt hour. The next area that we have been discussing and informing you about were planned negative regulatory changes in the Czech Republic. Before they went to the final reading and approval in Czech Parliament, the most drastic parts were removed. Then they moved to the Senate, and the Senate actually sent the law back to the Czech Parliament for rework. The last remaining unpleasant part of these new regulations, or this new law, is a recalculation of the IRR of these power plants that were connected under the original feed-in tariff regime until 2010. And based on the significant administrative burden that the power plant owners, irrespective of the size of the installation, so it would not only hit the owners of utility scale power plants like ourselves, but it would also hit owners of relatively small installations, as the minimum size was capped at 30 kilowatt peak, and many of these owners are farmers, sometimes schools, and this was viewed very negatively by the Senate, leading to the law to be rejected and sent back for rework and we will know in the next couple of days how Czech Parliament will react to this. We of course hope that they will remove these last remaining problematic parts of the law and approve it without them. So, in general, looking back 3 months ago, we're definitely in a much better position. We have, at the end of the year, as you know, we're also tracking and publishing the ratio between power plants that benefit from a feed-in tariff regime or a similar support scheme, and which part of the portfolio is merchant. Here we have seen a rebalancing. The share of merchant has been reduced due to the disposal of the Australian assets. So the 14.5 megawatts that we disposed of were merchant. The 3.2 megawatts that we built are also planned to be merchant, so that reduced that impact of the disposal. But the net effect is that we're currently 51.5% in support schemes with our generation capacity, and the corresponding 48.5 are merchant assets. But essentially, we are hovering around the 50-50 mark in terms of the balance in our portfolio. For 2025, we have again switched out our Czech portfolio from the fixed feed-in tariff system into the so-called green bonus system. So just to explain, once a year we can decide, latest by the 30th of November, whether in the upcoming year we want to be paid a fixed feed-in tariff or go into the green bonus, which is a lower amount, and the difference is determined by the future electricity prices. There's a relatively complex formula. That difference for 2025 ended up being around 42 euros, and it has been our belief, and looking at the futures prices and the pricing curve for 25 and beyond, we came to the conclusion that we will be able to generate more than 42 euros in the day-ahead market selling that electricity. So we made this decision to switch, and we have structured it within the group in such a way that between the various SPVs that own our Czech power plants and our energy trading arm, Photon Energy Trading, we have set a fixed PPA price that is slightly above those 42 euros, and the price risk, or the risk of that bet that we have taken, that energy prices in the market will be higher, is borne by our energy trading arm. But of course, from a group point of view, we have taken the market price risk, and we believe that this was the right decision. Again, looking at prices that we've been realizing since the beginning of the year, which on average were well above 100 euros, but also looking now at the monthly futures prices for 2025, we believe that we will end up quite materially above those 42 euros on average. Last but definitely not least, we have had our first unpleasant surprise in terms of the regulatory regime in Hungary, which to date has been a market that has been very stable in this respect. On the last day of January, when the Hungarian regulator should have announced the indexation of the feed-in tariff for the year 2025, which is based on a formula that is the average consumer price index in Hungary for the previous year, in this case 2024, and it's actually an average of the monthly numbers, minus 1%, which would have ended up being 2.7%. on that day when they should have officially announced it for 2025, the announcement was actually that the indexation for card projects, which in our case affects 33.6%, sorry, 33.6 megawatt peak of our portfolio of slightly above 50 megawatts in Hungary, are affected by this. And indexation is frozen for the next 5 years unless inflation exceeds 6% in a given year. So this is something that is surprising. It's of course unpleasant. It comes on the back of indexation of 16.6% for the year 2024. It means after the very high inflation in Hungary in the year 2023, we have seen a significant increase of the feed-in tariff, significantly higher above what we had in our business plan when we were building the plants 6-7 years ago. So it put us on a significantly higher trajectory. And from that point of view, it's also quite surprising that this change or this freeze happened now 1 year later. But it is what it is. And we're still generating, even without indexation, around 115 euros per megawatt hour from these assets. So it's a price that still maintains very good economics of the projects. But clearly, this kind of instability is something that came as a surprise. Again, to date, we have actually experienced Hungary to be the most stable country in the region from a regulatory point of view. So we do hope that it's a one-off, and there will be not more of these surprises. The impact is reasonably modest in terms of our annual revenue generation. However, it has had an impact on the value of our portfolio, which has gone up in our valuation models, but it could have been revalued by another more than 2 million without this change in indexation. So there's been a value impact for sure. It's not dramatic, but it has happened. Looking at other business segments, we have our engineering, and what we're seeing here are external revenues. So you can see that we have seen growth compared to the previous year. So in Q4 24, we generated 5.5 million euros against 2.4 in the corresponding quarter. But already the second and the third quarter of 2024 showed higher revenues than in the previous years, even if they're not end of the previous year, even if you don't see them in this chart. And this is mainly driven by growing C&I business in Australia, growing C&I business in the Czech Republic, and of course, the revenues generated from the construction of the 20 megawatt power plant in Pukenui, New Zealand. In new energy, as you can see, we have had, as predicted, and I think that we have communicated and explained that in detail throughout 2024. We have had a strong fourth quarter after a very strong Q1 and weaker Q2, Q3. This is simply due to the fact that the prices for DSR services contracted with PSE in the auctions that led to our contracting were the highest in Q1 and in Q4, and lower in Q2 and Q3. So the fact that Q4 would be stronger than the previous 2 quarters was expected, and it was nearly on par with the first quarter. But it was lower than the first quarter due to some regulatory changes in the capacity market, which are too complex to explain in detail now. That has had an impact, but as you can see, the impact was compared to Q1 around 9% of revenues. But as you'll be able to see later, new energy was a very positive contributor to our consolidated results. Then we have O&M revenues, where again here we're showing revenues coming from external business. That means from external customers. As you are aware, we are taking care of our own power plants. But this growth curve that you see here corresponds also with the growing number of contracts. What we do see, however, is a certain delay between contract signing and when we take over power plants under our management. This explains why we have signed over 1 gigawatt, but only around 750 megawatts are under active management and active O&M and generating revenues for us. However, the dynamics of signing up new contracts and also then with a certain delay taking over power plants is accelerating. So continued positive growth is expected in the next couple of quarters. The fourth quarter of last year was very important from the point of view of our technology division, which is our distribution arm for modules, inverters, and batteries. And as you can see, after, and I think we have also discussed it in previous calls, after a record year 2022, we have had a very tough 23 and an even tougher 2024. There's a lot of consolidation happening in the distribution market in Europe, and we have brought in a new team at the beginning of the fourth quarter, which has hit the ground running, and I think the best evidence is the very significant increase of revenues from this business segment in the fourth quarter. So if we compare to the second quarter, we grew from 2.2 million to 5.2 million euros, despite the fact that we had Christmas season, and typically the last 2 weeks of the year there's nothing going on. And of course, October was very much a period where this new team was in the run-up phase. We do see a lot of potential for PV technology to yet again become a significant contributor both to our top line but also EBITDA this year and beyond. So we have really made I think in terms of cyclicality, a well-timed move to strengthen activities in this field, while a lot of the other players are retrenching, and in some cases, and actually increasing number of cases, even disappearing from the market. Comparing the revenue mix between the years 23 and 24, you can see that new energy in both years was the most significant contributor in terms of revenues, followed by our energy generation. Engineering managed to increase its share. Technology, that means components distribution, has retrenched its share in 2024, which again, just come back to what I said before, we expect to grow again in 2025. And we believe that we're working very hard that in all these business segments we can show a positive development. As you are aware, in various business lines, we have differing gross profit and EBITDA margins. Clearly, the most significant contributor is our energy generation, with an EBITDA margin and of close to 83%, and followed by new energy, which had an EBITDA margin of around 14%. And in the other business lines, because these are consolidated numbers, group internal revenues play a significant role, and this is why these negative numbers need to be taken the way they're presented here. That means where intragroup revenues are stripped out with a certain pinch of salt. In the case of O&M, where you see a very significantly negative EBITDA margin, it is important to bear in mind that for 2024, the non-consolidated revenues of that business line were more than twice as large. It means that the group internal revenues were more than 50% of the revenues of this business line. So in this presentation, we took out the revenues, however, not the costs, particularly not the fixed costs, which are a significant part of feature of this business line. So in this case, the numbers look significantly worse than in reality they are. So essentially, this number of 1.8 million minus is the cost of operating our own power plants. The same applies to engineering, where of course we're also building for our own power plants, and technology, which also acts as a procurement arm for the construction for our own portfolio, but also for third-party EPC. And of course, these activities also generate a margin which is stripped out in this presentation. Good. And with this, I would like to hand over to David to guide you through our financial results.
Thank you, Georg. Good morning, everybody. I press the button to move the slide. Yes, so we start out with the profit results. A very good quarter. Revenues more than doubling, and this has come through very well from, as Georg has said, we've got a higher electricity generation, which comes in very well, and other revenues also sharply increased. This is coming on from several areas, new energy being one of them, and also this new team in technology. Now, at the moment, they've been clearing some stock, but they've also managed to write some very good contracts, and we do expect this to be a stronger and, importantly, a profitable contributor during the rest of the year. When we get down to the EBITDA level, the result is still negative. We were hoping that we would have a positive EBITDA in the fourth quarter. Some things didn't go our way. We had to reverse the profit, the gain that we booked on this Polish project. We do expect the reason for reversing it was because we had to postpone the completion of the contract. We still do expect that contract to complete, but obviously we had to reverse the gain that we'd taken earlier in the year. We have balanced that to some extent with the sale of another development project in the past where some milestones were achieved, and this produced some income for us. And we also had some unexpected one-off costs during the quarter, which meant that we ended up with this negative EBITDA, pretty much in line with the result for the previous period. Getting to the EBIT level, we did make a loss. We made a book loss on the sale of our Australian projects, although of course these projects generated 6 million of cash and also took us out of of the least profitable part of our generation portfolio, because Australian prices are much lower than the European prices. Into the cost side, raw material costs obviously increasing. This is actually quite important because in the engineering activity, we have spent money bringing things in for third-party customers. We've built them, but in some cases, because there are contractual payments, we're not managed to take the sale yet, but we have got the costs. Also, our other expenses have increased. This is partly the way we account for these things. Inside other costs are the costs of contractors working on engineering projects. When we build for ourselves, it ends up in our balance sheet. When we build for a third-party customer, the cost goes through this line of other costs. So this is not a story entirely about increases in overheads and other expenses. It also carries costs which are, in fact, direct costs to our business. Going forward, we might choose to show this analysis in a better way, because as our third-party EPC business grows, it will mean that we'll have increasing direct costs, which will be related to the increasing revenues. In terms of the technology, as we've said, very exciting news actually after 4 quarters of poor performance in technology. We've now hired a different team. We've widened the markets that they go into. We've increased the volumes significantly. And although the results were not profitable in the 4th quarter, they joined halfway through the quarter. They've cleared a stock overhang, which was a problem in our balance sheet. And they've got some, I think we're going to see some really exciting results from that new team going forward. Into the rest of it, I think we have revalued some of our portfolio, which helps with the total comprehensive income, but the quarter not quite as successful as we'd hoped. We'd hoped that we would make a positive EBITDA, but with the strong revenues, it's really a promising result. In terms of the overall year result, we're talking quarter here, of course. Revenues up 26%. Electricity generation 15%, even with the setbacks that we've seen in Romania and so on, and a very pleasing result in the other side, 31% up on previous year. So that's the profit and loss side. We go now to the balance sheet. Fixed assets increased. Fixed assets decreased, I'm sorry, because we disposed of the Australian assets. Current assets stable. This is mostly because we cleared out these inventories. We managed to clear nearly 8 billion euros of inventories, but obviously our trade and other receivables increased. This is partly because obviously we've got a larger business now, especially in the trading side, and we do have to wait to get paid for those. In equity, we're down due to the negative results of the operations. The adjusted equity ratio, which is very important to us and to our investors, goes down to 25.7%. But as Georg has said, these changes in Hungary, which are regulatory changes, do contribute quite considerably to that. why they contribute in something, why they contribute to the results in 2024 to something that happens in 2025 is because we've had to take down part of our the carrying value of our Hungarian power plants to reflect the lower future income which they're likely to receive. The impact on equity of this was 2.3 million euros. If we apply that to the calculation, our equity ratio would have been 26.5%. This is important because the bond prospectus, the arrangements which the bond are issued under, allow a carve-out for changes in our valuations caused by government interventions and regulatory changes. Of course, we don't stop reporting the adjusted equity ratio, but I think it is an important difference. If government does something that affects our equity, then it affects our ratio plainly. In terms of our long-term liabilities, we've of course made our normal repayments and so on, and by disposing of those Australian assets, we reduced our debts by 4.7 million euros. In terms of current liabilities, we increased trade payables by 7.5 million. Quite a lot of this comes from the third-party EPC business, where there's a lag between when work is done for us and when we pay for it, because we pay for it when our client pays for it. And then the other thing in there is we've reclassified one of our loans from long-term to current liabilities. Moving on to the cash situation. Our operating cash flow in the quarter was positive. We improved our investment cash flow because we sold the Australian assets, and in terms of financial, this is the reduction of those debts. In terms of the full year, because obviously we're looking balance sheet, cash has increased from 5.8 million to 8.4 million. That would be the end of the discussion about the results, but of course we do need to talk about guidance. We guided at the start of our actual results are 89.2 million for the year. We had guided between 90 and 100, so we're quite close to achieving that. In terms of the EBITDA, our EBITDA, preliminary unaudited EBITDA, is 8.7 million. This is 12.7% lower than the guidance that we've given of 10 million. At the time we gave that guidance, we did expect to be able to maintain the fourth quarter in a break-even situation for our EBITDA. In fact, we lost 1.1 million. That's partly because of having to reverse the gain that we'd taken earlier on our Polish on the Polish project that we're selling, and partly because we had some restructuring and severance costs coming out of the business, in particular out of the restructuring of the technology business. And then we took the opportunity to go through some of the old balance sheet positions, and that produced a further write-off. We'll give guidance for 2025 when we publish the first quarter 25 results. I think it's important to say in the guidance that when we went into 24, we were expecting to land more third-party EPC contracts than we in fact managed to. This does not mean that we that we've left this business. In fact, we are quite close to closing some negotiations in that, because third-party EPC remains an important part of our plans, and that would be the end of the guidance. Which takes us to the interesting parts of the presentation, questions coming in, and back to you, Georg, I think.
Yes, well, thank you, David. Well, we have received a fair amount of questions, which I've been going through, and I mean, some refer to the same topics, but I'll try to go through them as they came in. So the first question relates to the strategy for 2021 to 24 that we published back in 2021, where we set ourselves a couple of goals. And the one that is being highlighted here is we had a goal of building 600 megawatts for our own portfolio until the end of 2024. And yes, we stand at 129. And whether that was too optimistic. So, and the question is how we did on other metrics. So, well, the one metric we have hit is the 1 gigawatt in O&M. At least we have it signed. So that's a metric we hit. On power plants being built. Of course, we have come not even close to. And I mean, there are multiple explanations. I mean, one is clearly that. Developing the projects, and I mean, our model has always been to develop either full in-house or in cooperation with others. Back in 2021, some of the roadblocks, like for example in Hungary, that from a certain point onwards, no new capacity was available, or in the auctions that were conducted, grid connection times were 28 and 30. For example, just to pick one market, but also in other markets, development projects became a lot more complicated. So that clearly extended the timelines. That didn't help. After the boom in prices in 2022, as you are surely aware, there was a very significant retrenchment in energy prices in 23, so pretty much wiping out the economics of making. I mean, after a lot of interest by lenders and various parties in this industry, the exact opposite happened. In parallel, we have seen the emergence of the duck curve, which has even turned into a canyon curve, meaning that during prices of high solar generation, particularly during the summer and on weekends, even in spring and autumn, we see extended periods of negative hours. That means that the output of these solar plants has very low, and in some cases zero value, further impacting the economics of power plants. I mean, these are clearly all factors that have come together that in this form were not foreseeable in 2021 when we published this plan, and as a result, deploying significant amounts of capital into PV only projects has become a very complicated exercise. So it's based on multiple factors, and of course for us, in building our IPP portfolio, access to project financing on attractive terms, so in both in terms of interest rates, which by the way in this period also went up significantly, and at interesting leverage ratios is paramount. And based on those other factors I mentioned, that has become raising project debt for PV only, so without storage, and this is something that is only now starting to happen, definitely has become a lot harder. So we had a slow development in our pipeline, but of course also these changed circumstances led us to significantly reduce the speed of our deployment. Having said that, we are still working on building some additional power plants in Romania. We are building the 5 megawatts in Hungary, where we're planning to add more in Romania over the next 18 months. But I would say the goals for PV only are definitely a lot smaller. Going forward, there may be some additional investments into C&I projects based on a power purchase agreement with an offtaker, as we piloted in Hungary last year with our 658 kilowatt peak pilot project supplying a factory in Hungary. So, and we are working on the investment case of battery systems and both utility scale settings, but also behind the meter. So we will be directing our investment flows or our capex into hardware or to hard assets, clearly more and more into other areas than purely solar. There is a question, and later on another question relating to Photon water and PFAS. I will try to answer them later together, and I will now try to work through the questions relating to our energy activities, and then finish off with Photon water. So the next question is whether we switch to green bonus and market price in 2025 for a Czech portfolio. I think we have answered that. I can confirm this is the case. The next question relates to the sale of our 20 megawatt project in Poland in a transaction with a large German-based investor, which we have published. The reason is simply that the development steps to get the project ready to build, which is a precondition for the closing of the transaction, have not been achieved in 2024. So we are convinced that this will be the case in 2025. So this transaction is live, just its conclusion has been postponed. There are then questions relating to our bond, which I will also then aggregate and answer in one go. The next question is asking for a more detailed explanation about the situation in Romania, where two of our power plants had to stop production due to problems with the TSO. So these two power plants are affected by this decision by the TSO are power plants with a grid connection capacity above 5 megawatt, which means that they are so-called dispatchable power plants, where we had to install and have to use a special SCADA system that gives the TSO direct access to these power plants and allows them to dispatch these power plants, switch them off in case there's too much electricity in the grid, for example, so in stress events. And both these power plants are still in the testing period. So when we in the past referred to this arrangement with the TSO about the offtake until we get the license. So basically what happens between the commissioning and the moment when we get the license, we are in a so-called testing period. And which means that if the power plant is smaller than 5 megawatts, then this testing process is purely in the hands of the DSO. That means that the regional distribution company. If it's above 5 megawatts, it's actually both the DSO and the TSO. And what seems to have happened in the case of these two power plants, but as we found out, we were not the only ones in Romania, the communication between the DSO and the TSO over the last 2 years when PV power plants were commissioned and added to the grid has been not as efficient and not as streamlined as one would expect, and this has led to certain discrepancies where the TSO at some point has woken up and has instructed the DSO that they want to do some additional tests, and in the meantime, until they're concluded, these power plants need to be switched off. We're working very hard on resolving this, but this is not a long-term problem in the sense that these power plants would not be allowed to operate going forward. But during this testing period, the TSO has decided to take this step. We, all our team, is working in overdrive to resolve this, and our expectation is that in both power plants, this issue should be resolved within the next 2 months, as information stands today. The next question is whether we were unlucky as a company to invest in Hungary and Romania where negative changes impacted Photon revenues, or whether such negative changes happen in entire Europe. So if we talk about, and whether Europe is a good place for investments, and whether Africa is different in this matters. Well, I think we've been in this business now for a very long period of time. In year 3 of our operation, we were hit by these significant retroactive changes in the Czech Republic back in 2010 through the introduction of a 26% levy on our revenues. This was a really earth-shattering experience for us. And since then, we've seen various types of changes, either changes of law or changes of regulations, sometimes tax changes, essentially, but all aimed at reducing the revenues and the returns of solar investors in many countries. So it's also not only linked to Central and Eastern Europe. Back in 2010, the Czech Republic was the first, but a week later, Spain also introduced very hard retroactive changes, leading to lawsuits and arbitrations that are still ongoing as we speak. So, and after that, we had Italy, we had changes in France and Belgium, but of course also pretty much well, almost all countries in the CE region that had introduced a support scheme. So it was Slovakia, it was Bulgaria, it was Romania during its first wave, 2013-14, and we've seen those in some other countries. So the question is always how brutal and devastating these measures are. Similar things have happened in countries outside Europe, where incentive schemes were in place. So it's not only a European problem. In general, the hope and expectation is that if we sell into the market, that means we're not drawing any funds, any public funds, whether that is through an investment subsidy or an operating subsidy in the form of a feed-in tariff or a contract for difference, that interference by the state would not be so significant. But as we can see, this is also happening in some countries. And for example, this change in Romania, where the TSO all of a sudden, obviously after September 1st, is paying us a capped price, because the role of the TSO in this during this and this is also my understanding of the regulation on which this is based, is providing a market access service. So essentially, they're fulfilling the role of an energy trader. So once we have a license, we work with energy traders that sell our electricity in the market, and the TSO's role is pretty much similar to that in this interim period. And essentially overnight changing the rules that a significant part of the production is not compensated at all, and the rest is a cap. So even if the market price is 200 euros, we only get 80. The whole our revenue model is not based on any kind of public support. It's of course very damaging, in my view, also unlawful. And maybe at some point in the future we will also take action against that. Now is not a very good moment for that, as we still want to connect more power plants in Romania. But after 17 years in this industry, I think we've seen a lot of these things happening, and they are unpleasant. Whether Africa is different is really hard to tell. I mean, our experience is limited. Our focus now is on South Africa, and given that the market is in significant need of electricity, I believe that the risk of anything that would damage the development and construction of generation capacity in South Africa is relatively low at this point in time. But of course, nothing can be excluded. Yeah. Good. The next. Okay, I'll move to a question about technology. What margins we expect from selling components in 2025? Well, in general, the gross profit margin on components distribution is somewhere in the region between 7 and 10%, depending on, and it also changes during the year. But where inverters are more on the lower end of this range, maybe even closer to 5. So I would say that the whole bandwidth is 5 to 10. So some items are closer to 5, and on batteries and modules, probably closer to 10. And that is the gross profit margin, from which, of course, we have to deduct our operating costs. So it is, in comparison to other business lines, a low margin business. But on the other hand, if things go well, volumes can be significant. So the bottom line contribution would still be very material. The next question is how O&M services differ from assets under management. Because in the quarterly report we introduced an additional. We were splitting it up in the past between O&M and Cardio, which is our subsidiary that takes care of and services central inverters. And we added the third category, which is assets under management, and that is linked to a new service, which is asset management for PV power plant owners, which is a service that we have actually started based on demand from customers who have approached us. For example, in Hungary, where we already have 2 such contracts. The latest signing you could read in our press release, I think 2 weeks ago, where we signed an asset management contract for 100 megawatt with EDPR. So they essentially reacted to the demand of our customers, for whom we're providing also O&M. And essentially, the fact that we do the not only the O&M but also the asset management for our own power plants in that country clearly signals to our customers that we know how to do it, and we were asked and approached to do so. And it is, as opposed to O&M, where our technicians have to go and work in the field, and of course there's also some admin work related. Asset management is largely administrative work, and this includes many tasks of regulatory nature, making sure that the power plants are insured. So essentially, we do all the work that's necessary for the power plant owners in that given country, just as we're doing it for ourselves and for our own power plants. And from that point of view, the contribution margin, because we have very little in terms of third-party costs, is quite significant. And the revenues per megawatt are not too far behind the revenues for O&M. So it is a very nice and profitable addition to our service mix. We have been holding back with offering this as a service because in some countries, most notably Poland, a lot of the tenders for O&M service providers are conducted by the asset managers of power plant owners. So we did not want to be seen to be competing with essentially people running tenders for O&M services. So this still remains a concern of ours in relation to the Polish market, but in Hungary and potentially also Romania, where we believe that we have above average knowledge in navigating the regulatory situation and understand what needs to be done for asset management. We are open to take on these assignments as well, and they are a very important and stabilizing element for our O&M activities. So, and it's more profitable than the O&M itself. So if we had to decide between 100 megawatts of asset management, 100 megawatts of O&M, we would most likely tilt and decide for the asset management. Next question relates to our margin in O&M in Hungary, that it is the most profitable market, and that we are still working on improving the profitability in the other markets. So yes, the situation has not changed. Actually, Hungarian operations had a really good year, with an EBITDA margin of over 30%, which is really an amazing number. Based on the contracts that we have signed, that we may still sign, we believe that 25 will be even, again, significantly better. We are in different stages of the development curve, because Hungary we started about 8 years ago, Romania in earnest really only 2 years ago, and Poland is also still at the beginning of its development, having started O&M there about three years ago, and this is very important, as opposed to all the other markets in the region where we do the O&M for our own power plants. We don't own any power plants in Poland, so we really started it from scratch. Prices, Poland is a very competitive market, so the prices we can charge for O&M are quite significantly lower than in the other countries. It means also that the break-even point is at a much higher megawatt number than in the other countries. So the Czech Republic is growing steadily every year. We're adding a few more megawatts. We'll also be adding in Slovakia now. But what we're waiting for there is for a new boom in building particularly utility scale power plants to restart. We believe that, at least in the Czech market, that will be the case finally in 2025, which means by end of 25, early next year, we'll be able to start growing the megawatts in the Czech Republic again as well. But the Czech Republic is mildly profitable. In Romania and Poland, we are working hard on achieving the EBITDA break-even this year. And as we continue growing our business, the picture will of course improve. Just a second, let's quickly look at the question about the guidance on 2025 capex. Well, we have never given a guidance on capital expenditure, but clearly we have, finite resources, and we will definitely be directing them to the most profitable uses. We will see when we, as David mentioned, as part of the Q1 result publication, we will be providing guidance on revenues and EBITDA as we did in previous years, where that will also include the guidance of capex. That we'll take it up as a point to consider. Then there's a question about the measurable benefits of becoming the first energy aggregator in Poland. So this is a very important point. The market for system services, or also referred to as ancillary services, that means short-term, or definitely shorter-term flexibility than what we have contracted with the Polish TSO through the capacity market by providing DSR, where the response times is in several hours. Ancillary services is a matter of minutes. This market only started in earnest in Poland in mid-June 2024 in a somewhat peculiar way, where flexible assets from partially or fully state-owned Polish energy companies were included, and nobody else was given access, and only then at some point kind of the gates were opened for others to apply and start the process of becoming an aggregator, get connected to the systems of PSE for the provision of these services. And this is a relatively long process. One of them was to be recognized by the Polish regulator URE as an energy aggregator according to the energy law. Here we're the first. Today we have found the only ones anymore. But the real test is starting operations in terms of providing ancillary services. And here, this forum, I don't want to, not publicly yet commenting on when we expect to start the services. What I can say is that we have credible information that other companies that are working on the same are behind us. So, and as it appears, not just by a few days or weeks, but it looks like a few months. So our assumption at the moment is that we will be the first aggregator of flexible assets to provide ancillary services to the Polish TSO outside the universe of assets owned by fully and partially state-owned energy companies in Poland. And this is really important because there is a lot of flexible assets already. Of course, as battery projects are being developed and realized, the number and volume will grow very fast. And so the way we see it is that we will have a window of opportunity as the only, first and only, for a while only, aggregator of flexibility for ancillary services. It is pretty much at this point in time, it's pretty much top priority within our group to make maximum use of this pole position or head start, if you wish. And from that point of view, it is a very important driver for our business in Poland, in the Polish energy market, but also for our business line, New Energy. We are, and I think we've mentioned that, we are also working on starting ancillary services in Hungary and the Czech Republic. In both markets, it will happen after Poland. And the situation is different because in both these other markets, there are already existing players active. That means we are, if you wish, latecomers. I think we have a very clear idea where we will have an edge over those existing players. But in Poland, we simply will be the first. In a completely new market, I think it is obvious, looking at the Polish energy sector, that more and more flexibility will be needed. This is also best evidenced by an additional auction that the Polish TSO has announced recently for additional capacity still for this year. And as the energy mix is changing and baseload generation will be disappearing from the grid, flexibility will be important, and the volume of flexibility that the TSOs will be contracting across the region, across the markets where we operate, will continue growing. So being first, capturing that window of opportunity and establishing, and if I may say so, contracting as much of the flexible assets, as many of the flexible assets, as much of the capacity that is available in the market ahead of our competition. That means putting us on the trajectory of market leadership, hopefully for a long time into the future, is invaluable and as I mentioned before, the number one priority for us at this point in time. So on that basis, I will gravitate back to some questions that relate to our bond, where one question starts with the question or the statement that we repurchased 465,000 euros of nominal value of our green bond in the fourth quarter. This is evident from the numbers, and so I can confirm that. And clearly, given that and still are trading at a significant discount to the nominal value, this is a value-creating move for us. But of course, it is driven by our free liquidity to do so. I mean, against the total volume of the green bond, these are relatively small amounts, and we have done it. We've reported it. We may do so in the future. But I think the more important question is, there are several questions relating to the refinancing of our bond, or basically how we want to deal with the repayment or the due date of our bond, which is in November 2027. That means by now already in less than 3 years. I think specific steps will definitely only start in 2026, and the basis for that have to be significantly improved results in 2025. So our focus at this point is to materially improve our financial results in 2025, have a solid outlook and a solid basis for even stronger numbers in 2026, and that will set the framework for our actions and the path we will choose to come to a successful refinancing, repayment, or a combination thereof of our green bond. So it's clearly on our mind. It's not like we not to have this, but the better our numbers, the wider our options, and this is why a solid improvement in our financial performance in 2025 is now our focus, and this is definitely key to having multiple options open to deal with this refinancing need at the end of 2027. There was also a question on our ability to pay on coupons, so this is something we cannot comment, but I would refer to over 10 years of history of us as a bond issuer. And this would lead me to the questions related to our water division, in particular PFAS, and one of those questions related to PFAS in water also refer to Australia. So I'll start with that part. The sale of our Australian power plants in the fourth quarter clearly represented the reduction of our capital employed in Australia, but we still have our engineering business in Australia. We're still involved in the development of projects, and of course we are in the process of developing and growing our water and remediation business here. And but particularly, so this is something we still have. There are of course some strategic considerations in relation to how we want to develop our activities in Australia, and by default also New Zealand, where we are in the process of commissioning the 20 megawatt plant for our customer during the second quarter of this year. There are multiple options available to us, but specifically in relation to our water and remediation business and the particular focus on PFAS, Australia remains a prime market for these activities. And there was a question about Department of Defense. So I think the best way of putting it is the Australian Department of Defense is a relatively slow-moving organization, which we've also experienced during the pilot project itself. There is definitely the need to clean up a lot of sites. We are still involved in discussions about certain technical and scientific aspects and of the conclusions of our test, where the Department of Defense is extremely diligent and working with a wide group of external experts. This is a process that I'm also sometimes amazed why certain things take so long, but it is what it is. But what I can say at the point is that we have very good traction with other parties in Australia that have more or less the same problem. That means PFAS contaminated sites, and that goes across civil airports, that goes across firefighting organizations, but also industrial companies that have been using PFAS chemicals or have been involved in their production. And last but not least, also waste management, because the legislation in relation to cleaning leachate, that means water runoff from waste dumps, has become very strict and will become even stricter now in the next couple of weeks in Australia. So that water also needs to be cleaned. And what I'd like to say in the context of this is that while, of course, for us, our proprietary technology for in situ groundwater remediation is important and something that sets us ahead and apart from our potential competition. We are not approaching the market and customers as a single trick pony where we say, this is our technology, this is what you have to use, whatever your circumstances, even if something else would work better. So we have also developed filtration units to be applied for pump and treat when we talk about cleaning groundwater, but it can of course also be applied to cleaning industrial water that contains PFAS. And on that front, we have had our first very important market success, where in Q4 we've delivered one such unit to an industrial company in the CE region that had elevated PFAS levels. And that plant is already this filtration unit that filters PFAS out of process water, which then gets reused in the industrial process. That is already up and running and performing as expected. And so we are setting ourselves up as a company that will tackle a PFAS contamination problem with the most sensible technical approach, and we are increasing the options that we have available ourselves. Our crown jewel is definitely the groundwater remediation. Here, I would also like to add that we are working on an approach to cleaning soil, remediating PFAS soil in cooperation with the University of New South Wales in Australia, also in cooperation with the Australian Department of Defense. So that scientific dialogue we are having with them also extends to a cooperation in relation to soil remediation, which is probably as a topic even more important and bigger globally than groundwater remediation. So we're working on a solution there as well, and most likely that will also be tested either with defense or one other organization in Australia. Moving to Europe, over the last 18 to 24 months, maybe now that you've been following us and you heard us talking about PFAS, maybe you've also been able to see that media coverage about PFAS and PFAS contamination has increased significantly, and the level of awareness across the European countries is growing. I would almost dare to say exponentially. So it started with a very extensive piece by Le Monde and Süddeutsche Zeitung about and other media about 2 years ago, including an interactive map of confirmed and suspected PFAS contaminated sites across Europe. And now we see that the new EU Commission has put fighting against the dangers of PFAS chemicals by prohibiting their production and their use, but also encouraging the cleanup. Maybe in the not too distant future there may also be some subsidies in this area. So it's a high priority. The new limit set by the World Health Organization. So the pressure is increasing, the awareness is increasing, and this we believe will also lead to more business for us. So we're still in the process of this is really new, and it's not like there's hundreds and thousands of remediation jobs that have been awarded. It is really new. There's a lot of effort going into finding workable solutions, and I think that we are in a very good spot to benefit from what is now happening, which still leaves us with the US as a market, which is by far the largest. And there, what I can say is that we are looking for the right entry point for a company our size into that market, looking at opportunities in the public sector, but potentially also the private sector. But clearly the focus is now on Australia and Europe to win larger commercial deals, prove to ourselves, but also to investors that we can generate revenues from activities related to PFAS remediation. I do believe and hope that we have been able to answer all questions. Unless, David, you've seen one that I have omitted and that you want to tackle.
I think we've covered most of them except for the
Africa. Yes, please let me also answer that one. So as you've seen from our release, we are developing, among other, besides other projects, a large project based on the reagent technology in South Africa. Status there is that we have secured the land, we have started the process of preparing an environmental impact assessment study, which is mandatory for a project of that size, and we have essentially been granted grid capacity. What it means is that if we complete the steps that are prescribed in the process, we can secure 250 megawatts of grid capacity for this reagent project. And this starts with paying a certain fee, providing technical data, and also securing offtake, at least in the form of letters of intent, which will then lead to design works being commenced by Eskom, the grid operator, and ultimately it will lead to 250 megawatts of grid capacity. So it is in our control from this point onwards. We believe that by year-end 26, based on our information we have, we will be able to get the project to the ready-to-build phase, which means it will be fully permitted. But of course, this is only part of the story. What is also important is to find off-takers for the electricity, to find project financiers. We also need to sort out engineering questions in cooperation with Raygen, possibly also SLB, which is a major shareholder and technology partner of Raygen. We need to bring on board also equity investors, and this is just as important. And this is a process that we have now started in earnest, and that also has to happen to get to what we often refer to as financial close, for which the permitting is, of course, an important element, but by far not the only one. So our goal is to work towards a financial close situation at the end of 2026, but we should not forget we're talking about a still new technology in a new market. However, our project is attracting a lot of attention from what I would call the right organizations and the right people. So this will be important. It's a very important project for us. But let me also add that we are also working on developing other types of projects in the South African market. Some of it is our CNI projects, but also PV utility scale, where we have a 12 megawatt project in the city of Cape Town. And with this project, we're participating in an RFQ for a 20-year power purchase agreement with the city of Cape Town, which has again been delayed, not due to our fault, but the tip of the iceberg and the most important one is definitely our Raygen project, but we also, I would say, quite successfully developing traditional PV projects and creating value for the company and also positive cash flow. So, so the South African market for us is working well. Good. So if there are no more questions, I would like to thank you for your attention and also for your participation in the Q&A session. And we're looking forward to welcoming you to our next earnings call, which will be after the publication of our Q1 results. And this is also the moment we will be providing you guidance for the financial year 2025. So thank you very much for your attention, and we wish you a good day.